Last week, did you get an SMS from a bank? Something like you're pre-approved for 5 lakh rupees personal loan? Click to apply. You probably ignored it. Most people do. But pause for a second. How did they know? You never applied. You never gave them permission to check your credit. So what happened between their marketing team deciding to send offers and your phone buzzing one tailored just for you? The answer is 4 rupee check. Not the SMS, the check that ran before the SMS. My name is Sukhjinder Singh. I've spent 15 years inside Indian fintech. I built lending products, I've signed bureau contracts, I sat in meetings where these decisions get made. In the next few minutes, I'll show you the credit bureau ecosystem the way a senior PM actually sees it. Who the 4 bureaus are, who can legally access the data, and 3 products that power every lending decision in India. So let's get into it. Let me start with a simple story. Imagine it's 1998, there's no credit bureau in India. A person walks into a bank A on a Monday, takes a personal loan, then stops paying. Tuesday morning, same person walks into a bank B across the street, applies for a fresh loan. Bank B has no idea what just happened. No way to check, they approve the loan. This was the reality of lending in India for decades. Every bank was its own island, no shared memory. So the government did something about it. In 2005, they passed a law called CICRA, Credit Information Companies Regulation Act. This law is the reason credit bureaus exist. Here's how it works. Every bank, every NBFC, every microfinance company, they all send their customer data to bureau. Every month, who borrowed, how much, whether they paid on time, whether they defaulted. The bureau takes all of this, puts it together, creates a shared memory, then sells it back to the lender as a credit report. Now here's the rule that makes the whole thing work. If you want to pull bureau data, you have to give data. It's mutual. You report your portfolio or you don't get access. You cannot be one-way consumer of the system. The mutual obligation is what keeps the data fresh. So what does a bureau actually know about you? Every loan you've ever taken, every credit card you hold, every month's payment going back years, your current balance, and this is the one most people miss. Every time another lender checked your report, they know who's been looking, they know when, they remember. India doesn't have one credit bureau, it has 4. Most people only know CIBIL, that's a branding win, not a market reality. Let me walk you through all 4, quick and direct. And I want you to focus on one thing only. When does a PM pick this bureau over the other? First, CIBIL, the one your parents have heard of. When someone says check my CIBIL score, they usually just mean the credit score in general. That's how dominating the brand is. CIBIL has been around since 2000. Today, its majority is owned by TransUnion, an American credit bureau giant. Where does CIBIL win? Retail prime lending. Home loans, big personal loans, credit card at traditional banks. Every major bank reports to CIBIL, so the data depth of urban salaried customer is unmatched. Where does CIBIL lose? Speed. CIBIL refreshes data once a month. The other 3 do it real time. Second, Experian, the fintech favorite. Experian was the first bureau licensed under CICRA in 2010. Look at which bureau new age digital lenders integrate first. Kashi, Credit Bee, Navi, most BNPL players. It's usually Experian. Why? 2 reasons. 1. Real-time data refresh. Customer closed a loan this morning, by afternoon Experian reflects it. 2. Experian is better at new-to-credit customers. They've built an alternative data model. They can score people with thin credit files using telecom data, utility payments, even phone metadata. Third, CRIF High Mark, the Bharat Bureau. This is the one that covers the customer most urban fintech mess. Rural, low income, thin file, microfinance. CRIF runs India's first largest microfinance bureau. If you're lending to a woman in a self-help group in Odisha for a 25,000 rupees working capital loan, CIBIL does not know she exists. CRIF does. My rule of thumb for founders, if your customer earns less than 3 lakh rupees a year or runs a business doing less than 50 lakhs in revenue, CRIF is non-negotiable. You'll be flying blind without them. Fourth, Equifax, the analytics bureau, licensed in India in January 2010. The other 3 mostly sell you individual score or report. Equifax leans hard into portfolio intelligence. Say you run a 500 crore lending book, you want to know how is my whole book trending versus the industry. That's an Equifax question, not a CIBIL question. Strong for large NBFC, strong for co-lending setups, where 2 lenders shares the risk. Strong at risk benchmarking at a scale. If you only want to remember one thing from this section, remember this. Senior PMs do not pick one bureau. They pick 2, sometimes 3. And they pick based on who their customer actually is. A salaried engineer in Bangalore, CIBIL plus Experian. A vegetable vendor in Tier 3 Tamil Nadu, CRIF plus Experian. A large NBFC disbursing 2,000 crores a year, add Equifax for portfolio intelligence. Junior operators pick one bureau, usually the one their founder's friend recommended, and they live with blind spots forever. Don't be that team. Your fintech startup cannot just pay CIBIL and start pulling your credit report. It doesn't work that way. There's a law, and the law has a list of who's allowed. Under CICRA, only specified users can legally access credit bureau data. A specified user is an entity that RBI has approved to pull the credit report. By default, this list includes banks, NBFCs, insurance companies, telecom providers, credit rating agencies, SEBIs, and few others. If you're on the list, you get direct access. If you're not on the list, you have two real options. Option 1, you partner with a regulated entity. Most early-stage lending fintechs go this route. You build your product, you source your customers, but the actual loan is disbursed by an NBFC partner. The NBFC is the specified users, they pull the bureau data, they make the decision. You get the speed to market, they get the compliance. Option 2, the harder one. You apply to the RBI to become a specified user yourself. Now this is where it gets serious. In November 2021, the RBI amended CICRA. They opened up the path for fintechs to become a specified users directly. But there are 5 distinct conditions, and I want you to remember every one of them. Condition 1, your company must be incorporated in India and owned by the resident Indian citizen. Condition 2, you need to have minimum net worth of 2 crores rupees. And you must maintain this at all times. Condition 3, at least 3 years of experience processing credit information. Condition 4, a clean track record. No promoter or director with any economic offense or moral misconduct convictions. Condition 5, and this one is the most founders haven't heard of. You need a certification from a CISA certified auditor. So what is a CISA auditor? CISA stands for Certified Information System Auditor. It is an international certification given by the organization called as ISA. A CISA audit job is to check whether your IT systems are secure enough to hold sensitive information. For bureau data, the RBI wants the confirmation from someone qualified that your company can actually protect the data it's about to access. This audit is not a checkbox, it's a serious technical review. It takes weeks, it costs lakhs, and you have to renew it. So here's how it actually plays out. If you're Series A lending fintech, you don't have 2 crores of net worth on day one. You don't have 3 years of experience. You cannot pass a CISA audit yet. You go the partner route. You lend through a regulated NBFC. That's your fastest path to market. If you're Series B or a Series C fintech, you probably qualify. And the direct specified user route makes sense because it gives you the independence. My advice, know which path you're on from day one. Don't build a business model that assumes bureau access you haven't earned yet. Now we get to the part I care about the most because almost no content in India explains this properly. A credit bureau does not sell data. That's too abstract. It sells 3 distinct products at 3 different price points for 3 different moments in the customer's journey. Let's go one by one. Product 1, the hard pull. This one is the full credit report, pulled in real time with the borrower's explicit consent. What comes back? Almost everything the bureau knows. The score, every loan, every credit card, payment history going back years, every inquiry from other lenders, and the negative flags like written off, settled, and default. A hard pull leaves a footprint. The next lender who pulls the report sees that you pulled first. Hard pulls are where the actual lending decision happens. Product 2, the soft pull. This is the magic trick of lending. A soft pull returns most what a hard pull does. Score, basic profile, risk classification. But here's the difference. It leaves no footprint. No inquiry recorded. The borrower is never notified. Their score doesn't move. This is the quiet engine behind every pre-approved SMS you've ever gained. Product 3, the scrub. This is the one that most people have never heard of. A scrub is a bulk offline bureau pull. Not real time, not via the API. You upload a file, 2 lakh PAN numbers, maybe 5 lakh. The bureau processes overnight. You get a score and a risk flag back the next morning. This is the cheapest product in the bureau stack. This is how every pre-approved marketing campaign in India actually runs. Scrub the customer list, filter the score, send the offer. That's the pipeline. Now here's the part that matters the most. These 3 products do not run all time. The sequence depends on the customer's journey, and there are exactly 2 journeys. Every digital lending product you've ever used follows one of them. Journey A, the pre-approved flow. The customer is not applying, they're being offered. This is how it runs. Step 1, the lender starts with their existing customer list. 2 lakh saving account holders, they send the file for a scrub overnight. Step 2, filter the result. Score above 720, no defaults in 24 months, 30,000 customers pass. Step 3, send the SMS. Maybe 600 out of them start an application. Step 4, when they click apply, a soft pull runs to re-verify the score in real time because the scrub data is now 24 hours old. Step 5, consent captured. Hard pull fires, final underwriting decision. Step 6, disbursement. So the sequence here is scrub, soft pull, hard pull. Journey B, the direct application flow. This is the most common. Every digital lending app works this way. The customer comes to you, they want a loan, no SMS, no pre-approvals. Step 1, the customer enters basic info, PAN, mobile, income. Step 2, a soft pull fires immediately, right there on the screen. The app shows them you're eligible for up to 3 lakh rupees at a 14% interest. Wait, how does the app know the number? Because a soft pull already ran. Silently, no footprint, the moment they enter the PAN. Step 3, the customer likes the offer, they accept, upload KYC, sign documents. Step 4, right before the disbursement, with an explicit consent, the hard pull fires. Final underwriting, the inquiry gets recorded, money moves. So this journey is different. No scrub, soft pull first, hard pull last. So here's the master framework. Pre-approved journey uses all 3 products. Scrub to find you, soft pull to qualify you, hard pull to close the loan. Direct application journey uses only 2. Soft pull when you show interest, hard pull when you give the consent. A lot of junior people confuse these two. They copy a pre-approved flow into a direct app and they waste money on the scrub they don't need. Or they skip the soft pull entirely and they make hard pulls on every application, which leaves a footprint and drops conversion. Senior people know the difference. They build the right flow for the right product. Look, we've covered a lot today. Why credit bureau exists in the first place and the law that made them happen. The 4 bureaus, CIBIL, Experian, CRIF and Equifax, and why a senior PM picks based on the customer and not the brand. Who can legally pull the bureau data and the 2 parts to get there. The 3 products, the scrub, soft pull and the hard pull. And the 2 journeys that separate operators who can convert from operators who don't. That is the credit bureau ecosystem, not the textbook version, the version you actually need to build with. Now, if any of this raised a question about your own product, I want to hear them. Maybe you're figuring out which bureau fits your customer base. Maybe you're designing a lending funnel and you're not sure whether to run a scrub or go straight into soft pull. Maybe you have a user base and you're wondering if there is a lending play there at all. Whatever the question, there is a link in the description to book a call with me directly. If this video helped, send it to one person on your team who's about to touch the bureau data for the first time. My name is Sukhjinder. Thanks for watching. I'll see you in the next one.